Hey everybody, back with another dividend analysis, and today we're going to be looking at Phillip Morris International Inc., or PM. Anybody who knows anything about dividend stocks should know about PM. They're very big in the dividend appreciation as well as the yield in terms of dividend. So let's see if it's worth all the talk. As usual, we can start with the dividend yield. We can see they sit a little bit below 5%, usually between 4 and 5% when they're relatively well priced is what you're going to see, so just keep that in mind. And if we go back and look at the history, we can see that about 8 years ago we were getting 85 cents per share, and currently we are getting $1.20 per share. So we can see a lot of growth here, and if we actually look, there has been decent growth every year. There was a big jump about 7-8 years ago, and then they've started to slow down to about 2 or 3 cents. With one big 7-cent jump in 2018. So there has been a good bit of growth. It's been roughly stable, a good somewhere between 3 and 7 cents over the past few years. So some good steady dividend appreciation there. Next, let's go look at the free cash flow and see what's going on. First, we can check their dividends paid here, just under $7.5 billion. And if we go to our free cash flow, we'll go 4 quarters. We can see that over the past 5 years, their free cash flow has been increasing, not by a ton, from about 7.25 up to about 8.5 billion. Not bad, but not amazing at all. They're really, this average of about 8 billion is really where their numbers are sitting. So it's very steady cash flow, not big ups, not big downs. We can see that if we go back even further, really 9 to 8.5, a little decrease, but it's been up and down slightly with only one real number. One outlier there. So the cash flow, very steady is a good way to put it. Next, we can check out their payout ratios, and first we'll start with the free cash flow ratio. And if we divide our dividends paid by last 12 months free cash flow, we get 87%, which is a little high. It's well above our ideal range of 50% and even above our acceptable range of 75%. This isn't necessarily a deal breaker. This could just be that the company's way of giving cash back to its investor is not through buybacks, it's not through other things, it's just they are going to do it through dividends. That's okay. A lot of companies operate that way. That's fine. But the only issue is at 87% of free cash flow, there is not a lot of room for error. There's no wiggle room for that dividend. If they want to raise the dividend, it can't be very much because they don't have a lot of room unless that free cash flow jumps. If their free cash flow starts to fall by anything more than a little bit, such as, for example, here, it fell by about 700 million, they still had room. If this happens again and then again, they're going to run out of free cash flow to pay that dividend. So keep that in mind. If you're looking at this, that free cash flow needs to be increasing if they continue to raise that dividend. Next, let's look at our income. We can see that last year, almost the same as our free cash flow here at just under 9 million. And if we get our payout ratio, it's just slightly better at 84%. Again, not within our acceptable range. And as we can see, they've had very flat income over the last 10 years. So while they have been increasing their dividend, their income and their cash flow have not been increasing to match that. If I'm invested in that company, that's a little worrisome. If I'm a dividend appreciation investor, for example, I don't want to see them do any more than those 2 or 3 cent raises, because if for example, next year, the year after that, these numbers stay roughly the same, and they come out with a 10, 11, 12 cent dividend increase, I would be very skeptical of their ability to pay that. So just keep that in mind. If you're in this, you want to see those 2 or 3 cent increases per share year on year if their if their cash flow and their income stays the way it is. These very, very slight increases to flat over the long term. So what does Philip Morris do? I'm pretty sure everybody knows. They make and sell tobacco and other nicotine-based products, cigarettes, chewing tobacco, whatever they want to do. Some things to keep in mind about the industry is, don't listen to the noise you're hearing. The tobacco industry is not dying. The world is not the United States and Western Europe. Even in the United States and Europe, smoking is not decreasing in total number. The people who use tobacco products are in some places decreasing in the amount per population, but the actual real number is increasing. The other thing to note is that Philip Morris does a lot of international business, and the rest of the world, tobacco use is skyrocketing. In places like China, Southeast Asia, Africa, smoking is what people do. There are some countries where over half the adult population smokes. This is not something that's going away. This isn't an industry that's going to die. This is very similar to people who talk about the oil industry going belly up. It's not going to happen. These people don't understand the way economy works. They don't understand how trade works. Don't listen to that stuff. It's not real. So, is this an investment you should be in? Is this for a dividend investor, an appreciation investor, an income investor? It's very hard to say. Those payout ratios are very high, so you have to be careful here. The appreciation, as we saw, has been very good. It's been very steady over the past 3 years at 3 cents per increase. It has been slowing down over the long term, but that's okay considering that their cash flow and their income has been very stagnant and their payout ratios are so high. So if you're a dividend appreciation investor, this might be something for you, but you really have to look into it. You need to see where they're expanding, what markets they're getting into more. Are they acquiring any other smaller companies to try and increase their income and their cash flow stream to get that dividend to keep going? This is the kind of research you need to do into a company like this. If you're an income investor, almost 5% is a very good income dividend. The only issue, again, is how safe is it? As I've said with a few of the other dividends, this would be something you would really want to pair with something a lot safer, something with a much lower payout ratio. Say you took a Philip Morris and you paired it with some other kind of consumer staple like a Coke or a Pepsi or a Procter & Gamble, so on and so forth, to spread out your risk so that if this does have a problem with its payout ratios and can't afford to pay, you're not going to be losing too much appreciation or too much income if something happens to their dividend. Overall, it's not a bad company by any means. They're not going to go out of business. It's with those high payout ratios, you really have to be careful. You have to do your research into how are they going to be able to expand their cash flow and their income to keep those dividend increases coming in the future. I hope that helps, and thanks for watching.